Okay, so as I said, we're going to talk about the business plan and its purpose to show a funder or a lender what you're all about and why they should invest in you and how much is needed. Now, sometimes you do that online because some of these, if you are going down the angel route or lenders, whatever, they quite often want online applications filled in, and quite often they ask you to attach a business plan. Sometimes there's the even if they don't, usually the questions they ask you will be effectively part of the business plan and the content you'll have in it. In terms of other practicalities of a business plan, it's a document or a PowerPoint or a Word document, whatever, and it typically it's within usually 10 to 20 pages long. Some are 20 odd pages. If you get any more than that, it's probably too long for people. And some can be even shorter than 10 pages, but 10 to 20 pages tends to be the kind of right length for it. And I guess one of the key things about it is that it's in plain English. It should be as clear as possible. We quite often, as I say, get clients come to us, and especially if they're quite techy, they can write the narrative for their business plan, using lots of jargon and complicated terms, etc. And it's important to try and avoid that. And if you are using certain technical terms, to define them quite early on, so it's very clear to a reader. You might well be giving your business plan to someone who works in the same industry and therefore understands very much what you're talking about, but you might not be if you're giving it to someone who's a funding circle, for example, or a local lender or whatever. Then they may well not understand that sector straight away. That's it. Yeah, it's not possible to get on.
No.
Right, okay. So we've got a one-pager business plan contents which will circulate, but basically it's kind of general format, if you like, is that we'll have an exec summary at the start, and quite often we fill that in actually last, because once you've done the rest of the business plan, you can actually go back and write the exec summary and the key points. You talk about the vision and what the business does and what the business does differently from others, what the business goals are, what the initial idea is. And then you also look at the marketing. How do you, about the sector, about the customer base, how are you going to price it, how are you going to promote and advertise it, that kind of thing, and all about the local market, which can be as simple as geographical, if you're, say, open up a cafe or whatever, and how the competition around that kind of area, or it can be something much more complicated if you're looking to develop something new and technical.
I guess to a degree, some of these are really kind of documenting what we were just talking about earlier on. That first half there, it's really kind of capturing where the market is, documenting it, etc., isn't it?
Yeah, absolutely. And just so you've done your research as well. But if you've got a good idea and you want to run a business, it's very likely you will have done that, because you want to de-risk it for yourself as much as possible. In terms of the practicalities behind that, so you've got the idea, the vision, how you're going to market it out there, but you then got to talk about through the practicalities, the operations of the business in terms of staff, premises, equipment, suppliers, that kind of thing, and how you're actually going to to deliver it practically. So it could be quite obvious in some cases that you're going to create leads from here, you're going to make the product here, it's going to take this kind of timeline, this is how you're going to sell it for this price, what kind of profit do you expect, and who's going to buy it. So it's just practicalities of that, and you'll have to sort of think through and show clearly to the potential investor or funder. And the last section we usually see is the finance section. So we usually, with your projections that we've talked through, you generally will have your 3-year monthly profit and loss, cash flow, balance sheet projections. Could be 5 years, but let's say it's a minimum of 3 years. They'll tend to be as an appendix to the business plan. So they'll be there, and then the key points of that, those projections, will have in a finance section in the business plan that will I can tie into it, basically. So the projections will show you, for example, key things about your break-even point, your cash flow maximum deficit that you've got in your projections, and these things can be summarised in the finance section of the business plan with some key assumptions behind those numbers and etc. So we'll see an example in a moment, but that's you've already got so the full financial projections will be as an appendix, but you'll have a shorter finance section in the business plan summarising that. And some of those key messages from the finance section, quite often we can copy and paste up to the exec summary of the business plan, and actually you can actually just repeat some of those things, not all of it, but just some of the key points, like break even, like cash flow requirement, that kind of thing that's in the exec summary. Okay. Let's go back to the slides.
Slides. Yep. You can see Mark and I are masters of technology.
So yeah, go back to this one.
Yeah, we'll need to
back up again. Go back up.
Yeah.
So as I was saying here, that length, language, simple, visuals. What I mean by visuals is that quite often what we have is, once we've agreed a business plan content and the financial projections with a client, quite often we then add graphics and colour and so on and make it look good for professional. Sometimes you have people have handouts as well if they're wanting to maybe not have something in the business plan they can give to people as well separately. And as I said, the appendices to the business plan will tend to be the projections, the monthly projections. Sometimes the CVs, short summary CVs of staff, are also contained in an appendix. More often than not, they're in a staff section in the operational section of the business plan, and a one pager. But sometimes people put them in as an appendix. Who writes it? Well, it tends to be the best way is that we give sort of headings and guidance to the client, and then they go away and populate as much of it as they can, because they're the ones that know the business the best. And they might leave out certain sections because they're not too sure. And then we tend to take it and expand on it and ask some key questions and then put in the financial bit as well. Sometimes clients say, "Oh, can you just do it all for us?" But in reality, then we're probably going to have to sit down with them for quite a long time anyway to download all information from their brain anyway about the business. So it tends to work better if they have a go at it first under some of the headings.
I think, to be fair, just add a couple of things. I think, to be fair, most of the time the owners of the business have got far more passion about the business than the advisor do. The best one in the world, we're there to support you as an advisor, but you are living and breathing the business, so that comes across when you write the business plan. And just going back to the language bit, particularly in techie businesses, we find a lot of jargon used. Try and avoid that, because if you think your plan is going to maybe a bank manager, for example, who will be looking at a mortgage advisory business one day, might be looking at a widget producer the next day, could be looking at a chemical developer the next day. So they're generalists. So you want to try and avoid as much jargon as you possibly can in the business plan narrative. There was a guy years ago I knew that used the term the granny test. If you could put your business plan in front of your granny and your granny understood it, then you've done a good job. You know, and that was almost a kind of good test. So really avoid the kind of jargon as much as possible. Keep it simple and keep it interesting using visuals and language, simple language.
But it'll be quite often we're going back and forth with a client. They'll draft it, we'll add to it. They'll draft a bit more, we'll add to it. We'll just kind of work on it together and then eventually, as I say, add colour and graphics at the end to make it look professional. But again, we'll see an example shortly. I guess what the kind of key message you're trying to get across in your business plan is the practical challenges of how you're going to kind of deal with operations and how you're going to cost things up and how you're going to price things up, all that kind of thing. There was for example, like quite often, looking at kind of quite a renewable energy type one that we looked at, where the client had very much said, we're going to construct this device and we know all the parts and components, so we've costed them up piece by piece, and this is all the prices of them, and this is therefore how much it's going to cost to manufacture. I added some labour, some overhead sort of thing, and then they said, right, we'll add 20% to that profit margin, and that's what we're going to sell it for. Sometimes it can be the other way around, that the market's going to dictate this is your price. You're not going to be able to change the price from what other people pay for this product, so therefore you need to make the costs work behind that, and therefore you kind of build up the costs of staff and so on behind that to still give a profit margin in between that and the price. So it's different for different sectors, but as long as you show clearly how you would actually do that, and what you expect in terms of profit and cost. That's the key thing. Focus on benefits, not features. The third bullet there. What I mean by that is, so if you think about, just take this example of some kind of renewable energy device that recycles energy, then you might talk a lot about, well, certainly in my experience, the client might talk a lot about the scientific methods behind recycling and how it operates, but really what the benefit is that it's going to save you money, because it means your electricity cost is going to go down. So that's the key thing. That's what's going to be why someone would actually buy it. So exactly, yeah, provide examples. If you've got, it can be difficult in a new business, but if you've got anything, examples or case studies, testimonials, we can put them in the business plan. Some people do it in a nice sort of graphic way with little bubbles, whatever, or some that's just kind of set out, you know, in a certain section. Here is some of the case studies and nice things people have said about us so far. In terms of the last bullet about higher level project plans, I mean that's I guess timelines and things like that. People quite often put in a timeline of from can be what we talked about earlier in terms of from order through to delivery, order from customer, manufacturer through to delivery, or it can be the milestones of, okay, over the next 2 years, here's what we're going to do. We're going to get the funding. We're going to do this, and that. We're going to expand here. We're going to take on more staff. And if you can show that in a diagram or whatever, so much the better. But as long as it's clear to people what it is that you're trying to achieve and by when. TRL level that I mentioned there, again, that's because I deal with some technology businesses, that's at technology readiness level. So quite often a technology business will say, right, we've got an idea at TRL level 1, and then we'll build on it and research it in a lab, and then that goes up the TRL levels. At each TRL level, they get more investment because they can show through the test results they've made more progress. They get more investment and so on, and they keep going up to TRL level 9 where they can actually market it. So there's different things again for different sectors, and KPIs there at the end, key performance indicators, how you're going to measure your progress and success as you go on. Could be simple as number of customers, revenue, etc., orders, whatever it may be, activity, inquiries, website hits, who knows. But that's how you're going to measure your success and progress over the next couple of years.
The one thing you'll find is, Mark, is the key message for funders is that a business plan for a startup can be very different from a business plan for an existing business, because if you're up and running already, you've had customers, so you've got customer experiences, you've got a lot of the kind of track record there already to speak about. Whereas in a business plan for a new start business, you're working in hypotheticals to a degree. You're kind of trying to visualize, you know, what the customers are going to be like, what they're going to say, etc. You're trying to visualize a lot of things. So the business plan for a startup can look very different from the business plan for an existing business.
Yes, absolutely.
So we've got a new attendee in the call, is it?
We do. She's come to join us. This is Riley.
Ah, that's cute.
All right. One of my daughters is called Riley. Lovely. Yeah, so also continuing on, competitors, we've touched on it a couple of times. How does your product or service compare to them? What you're going to do differently? Could be as simple as your quality, your personal touch, your database, as Zoe, for example. But it's how you're going to show you're a little bit different from others. If you've got a team below you, then again you can present their experiences and their CVs, etc., short CVs, and the business plan in terms of their experience, what they're going to add, what roles they're going to play, and if you can, show how you're going to keep people whether committed to the business and hopefully paying obviously market rate salaries. Maybe some of the other things that we mentioned earlier on, like share option schemes and so on, for the future. Quite often, you don't have to go into too much detail. Sometimes you can just say, like, as the business grows, we'll be looking at employee incentives to expand, keep the team, retain the team, and expand the team in terms of share option schemes and other tax efficient kind of schemes for staff. So it doesn't need to be particularly detailed out. It's just because you maybe, you know, a couple of years away before you're actually going to do anything with that, but at least you can maybe mention that. And look at the future, paint a picture of life after 2 years beyond the financials. So eventually what you're going to actually look like. It, again, doesn't have to be too much detail, but if you can put down something that shows you even more what the potential of expansion in the business is, then so much the better. For example, if a client's opening up bistros, cafes, would they be looking at franchising maybe after a few years? So you can maybe mention that as something that will be something we'll look at in the future. And you might have a definite idea of what you're going to do in terms of an exit strategy. So you might say, well, after 5 years after we build this up, we're going to sell it, and then we get a return, and you get a return investor. So, but it might be a bit more open-ended than that. But it's worth thinking about what's going to happen in that kind of 2 to 5 years time scale. Last bullet, test your propositions on others insiders. So if you're looking at getting an independent person, even a friend or a mentor or whatever, or your accountant to look over your business plan, your projections, make sure that it's understandable, and ask their honest feedback as to what's going to, if they were an investor, what would they think and what would they ask for. Yeah, a bit more in competition, and analysing their strengths and weaknesses. How's it compared to you? And it might not be that you're actually wanting to compete with them directly. It might be that you want to offer something different, something cheaper, more expensive. It doesn't necessarily have to be a head-on thing. Are you offering something different from what they do? And analysing how they extra things that they do that might make a difference in terms of after sales service and other benefits, discounts they offer, and the USP, unique selling point. So what's your unique selling point of yourself or your business or your product, in terms of price, service, promotion, or whatever? Could be a number of different things. Last point there about intellectual property, IP and patents. It might be if you have a new product, commonly sort of in a technology space, then you might want to patent it, so that it can't be copied, because an investor's going to want to know if you've got a great idea, a great product. What if someone comes along and just copies it and can do it cheaper or whatever? Does that mean that the business is viable? So it might be that you want to patent it or whatever, just to kind of protect yourself, and it may be worth looking into things like that. Example of a business plan. So if I go stop sharing,
yep.
Go down,
got to
share, and then here,
yeah,
I'm going to show. Yeah, here we go. So I've just got an example business plan to kind of show you. This was a business plan that we'd worked on a good few years ago now, and this was a business, new start business that in the sort of renewable energy, clean tech field. And what they had done, what they were developing, was that they are, as you can maybe tell from the diagram, it was something to do with car engines, and they developed a device where it would attach itself to a car engine, and it was full of various liquids, and it would recycle the heat energy and the vibrations from a car engine through the liquids, and it would use that to power some rotating fins that would recycle the power back into the engine. So increasing efficiency, not wasting power, using it again, recycling power, and therefore it was initial discussions with big car manufacturers were promising, they said, but they needed funding to kind of get it progressed along. I've had to anonymise this example, so you can see that I've got some mentions here of logo, and there's some blank spaces because I've had to take off the client name, and anything else that would be non-confidential, and anything that would be confidential. So it doesn't quite look as good as it could, but it just gives you an idea. So I've obviously replaced some of these things with generic terms, but just to kind of talk through it so you can see. And this has a kind of structure, a bit like we discussed earlier, in terms of the exec summary and the opportunity. You can see there on the contents page the kind of things that we talked about earlier, the market, the strengths and the competitors, key personnel, and the future and finance, all the things we talked earlier. And the appendices here, we had one about company structure and policies, which is relevant in this case. And then we had the financial projections, each split into a different appendix: profit, loss, balance sheet, cash flow, a few other things sort of popping out of that as well, working capital, loans. So very much in the kind of headings we talked about earlier. This one's, as I said, this one's quite a technical one, so inevitably there is some technical terms in here, but it's just trying to make it as clear as possible. So I'm obviously not going to go through all this narrative, but it's just to show you the structure and what it could look like. That you've got a kind of exec summary here, summary of key points. You can see that it's only a page. It doesn't need to be War and Peace. It just needs to be clear and obvious to the reader what the position is. You can see here that one of the first key points is stating what we need for investment and what it's for, the amount we need, and what we're expecting in terms of other investment. Here's the opportunity for it. They've got a patent pending, so they know what's going on. That's one of the things I mentioned earlier. And then into the body of the business plan, looking at the opportunity, what in the market, and why this new technology would be important. Some more stuff about the actual company and what they're trying to achieve, what they've done so far. And market research in section 4, quite a lot of detail in there, and therefore why this product's going to be extremely desirable. It's all about clean tech stuff, so there's a lot there about obviously government targets as well, and what people are trying to do in terms of electric cars, and why it's important to where the opportunity lies for this product as the demand for clean tech stuff increases. This is the route to market, so this is kind of what they're actually going to do practically in terms of approach people, do this, make pitches, contact people, further progress their prototypes and the product. Again, I blanked that out because it was confidential stuff. What the strengths are of this company, this product, what other products are out there which could be competitors. So that's a good knowledge to show someone, and why we are different. What advantages do we have? But obviously, but also being balanced is thinking about the risks involved as well, and how they're going to be addressed here. I suppose in a practical term, if you're thinking about a more relatable day-to-day business like a cafe, in terms of what do you do if someone opens up nearby? How do you compare to the competitors that are there? So what would your plan in that case? Key personnel, again, blanked out because I had to keep it confidential. Future plans, and the finance section at the end. And you can see that the finance section is just a page. So again, doesn't need to be War and Peace. The projections are there, which will have the monthly breakdowns of P&L, cash flow and balance sheet. This is just a summary table annually, showing revenue, any grant income, salaries, other costs, EBITDA, which is commonly sort of shown in terms of a business, earnings before interest, tax, depreciation and amortization. That's quite a common metric in terms of valuing businesses as well, because it's seen as kind of like operational profit, if you like, because it's basically net earnings before interest, tax, depreciation, amortization. Though depreciation and amortization is seen as kind of non-cash outflows. Tax obviously is always going to be there, but it's something that's not really to do with the businesses. The business can't control. And interest as well, because I guess a potential investor or purchaser can change the structure of the finance within the business. So EBITDA is seen as a kind of operational profit measure, if you like. And at the bottom of this table, lowest cash headroom. So in Ewan's example, for example, we had that 38,450 or so, and it was the lowest cashed deficit in the model and the projection, and they were showing people here that this is, and that every year this is the lowest cash amount here, and the projections in this case show the investment coming in. So this is showing effectively the buffer, what you've got above zero in terms of every year based on the projections. So, and you can see here again just a few key points from the projections in terms of what investments projected, what we want, this key statistic, key assumptions behind revenue, we're licensing out this technology at £10 a car, and some other key assumptions and what tax rate we're assuming, and ultimately we're projecting positive cash with the investment we're going to get from yourselves, the 690, and it's just very clear, very kind of summarised. And again, we can take some of these key points and take them up to the exec summary, which we saw at the start, and then there's the appendices. So going back to the start here, you can see some of the key points here are straight from that finance section. Okay, so that's why we kind of do those sections last, because once we've got everything else done, we can populate the exec summary. So that's just to show you the kind of structure, and you can see that's about 20 pages long, as I was saying, maybe about 18. So as I say, that's the kind of good length of a business plan to show someone. Again, as I say, even if you're applying for a loan, it's probably that kind of information you're going to have to input in terms of financially and narrative wise. Or we've done a lot of online applications to angel investors and venture capital investors as well, where you're going on filling in online applications, and it's summarising, it's putting in some of this narrative and some of these numbers, and then usually attaching the business plan anyway at the end. But you can see that even if you're pitching to friends and family, that's what the kind of thing that they'd want to know anyway. So you can get this example, we'll get this sent round afterwards, just so you can see it and you can take it away, but it's just to give you an idea of what's actually included in a typical business plan. Any questions at all on that? No? Okay. Good, okay. Do that. Do this. There we go. So, okay. So yeah, that was that example of business plan. I guess I wanted to go into now the pitch or the pitch deck, because you've got your business plan, you've got your projections, you're happy with those, but often, of course, when you're either talking to someone about your business idea or your investment opportunity, whether it's informally or whether you're actually in front of a panel of investors listening to your presentation, it's kind of the same things that you really need to be talking about. And it's kind of, it's an even more summarised version of your business plan and your financial highlights. So, and quite often you don't get too long to actually make the pitch. This is just this slide is just, I guess, showing you the difference between the business plan and the pitch, because I guess the business plan is dealing with what you're showing here on the bottom left of this slide, which is your hard factors, your credibility, financials, expertise, the market, your solution, your product. But then when you get to the pitch, then you're talking more about the middle box, which is the soft factors, how you come across, what you're like, because they're ultimately investing in you, and the people. So it's more like the kind of soft factors about how you can breed confidence from what you do. I
guess really the pitch is really to kind of get them hooked, the audience hooked first of all, and then you can follow up the detail in terms of the business plan after that. Yeah, it's really to get them on board.
Yeah, because ultimately they're going to want to know, can you work with it? Can they work with you? And what will they deliver this? Because they may be involved. Or maybe just very much a sleeping investor, but they're going to want to know that where their money's going and they feel confident about it. And on the right-hand side, we've got risks, because I guess the buyer's going to think about, okay, it's risky for me to put this money in, but they'll also be thinking about, I don't want to lose this opportunity either. So what's in it for me, effectively, is what they'll be thinking. You need to put yourself in their shoes. we touched on a bit earlier about sources of funding and where you might actually pitch to and apply to. So again, it starts at the top of the list. We've got more informal ways of funding, your own money, friends and family, startup loans. We touched on grant applications, and then kind of goes up the formality chain, because then you're looking, maybe if you're looking for equity investment from angels, from venture capital firms, you can go online, you can get lists of angels and venture capital firms, and you can, as I say, go on and online apply. And if you're successful in your application, then they might come and invite you to actually pitch to them. Industry players, what we mean by that is there may be people in your area who want to kind of bolt you on or whatever, or synergies with you, with investing in you. So it may be part of a kind of wider strategic play that someone else might want to, who supplies you, or you supply them, might want to invest in you and make you part of it.
That might be the case with new technology, for example. If there's new technology in a sector and a big player finds that technology, they may want to invest in you to try and take it forward, because clearly it benefits them. Yeah.
Crowdfunding, you mentioned earlier on, you can go on to, there's lots of different crowdfunders out there, Crowdcube, etc., and all sorts of ones. And this was all, I guess, one of the first ones here was Brewdog, the sort of craft beer manufacturer, who are almost going into liquidation, and they needed money, and they went out and said, right, all our customers, why don't you guys take small amounts of equity in us, and for that you'll get a return, but also get entitled to some bonuses like free beer and things like that, and other things. So it's quite often quite ethical things, or sort of niche things that get crowdfunded. Like, for example, we had a client who supplied vegan food, and they went on, and obviously that's a cause that people are passionate about, so they wanted to invest in that. The public wanted to invest in that to promote it, and then they got entitled to discounts and so on. So that can be a good way of raising funding. So they raised some money through that as well. Loans, mentioned about, whether it's bank loans, whether it's loans from alternative investors who are a bit more, have a bigger appetite for risk. You may see these terms, Series A, B, C, etc. So once you've raised your seed equity in a business, if you then want to go out there and raise more equity finance, then it's quite often called Series A. The next round, as you grow, Series B, Series C, etc. So you might see those terms bandied about. And in our experience, if you are going to do a formal pitch, you might only get 10 minutes plus a Q&A. It's not too long, so you can't, you maybe don't get an opportunity. You have to think about what it is you're going to say within that 10-minute spell. And quite often, even I suppose informally, if you're talking to friends and family, you might only get 10 minutes as well. So actually go, you have to hook someone, don't you? Quite quickly.
That's quite, the angel bit is quite interesting as well. We've been involved with angel syndicates in the past, and they have what they call the showcases. And as Mark mentioned earlier, the process they go through is you send in your proposition, your business plan, etc. They then have a kind of committee that review all the plans that come in, and they get lots and lots of them, to be honest. They then filter that down to a certain number who they think their angels would be interested in, and they then have to identify individuals within their syndicate that they think would be interested in this proposition. And they then come along to a presentation where the business presents to these angels, and they have that pitch, and then they have the Q&A session. And these pitches can be in person. I mean, before COVID, for example, they were using hotels in Glasgow, and they were renting rooms there where people would come along and do a physical presentation to the angels. And then it's also now, obviously, since COVID, it's gone online, where the business goes along and pitches online, and the angels are all similar to this arrangement. They're all online, and they ask their questions in the back of that. So it's quite an interesting one. It's quite daunting, I think, for the businesses, because you're standing up doing your pitch, but you also then have to think about, when you are presenting to these guys, what else can they add to your business beyond the money? And that's important. So some of these business angels, for example, may have relevant experience that you're looking for in terms of engineering or production or finance. And so they may come along not just with the money, but also able to add value beyond the money, which is quite important.
Yep, absolutely. Just about the investment process. So start at the bottom here of this triangle. I guess we've taken it to the point in this today where we've got our funding need identified, we've got a business plan, we've got refined projections, we've even maybe got a pitch deck and of slides to show to present to someone. So you know what you need. You set up contact meetings with potential funders. You apply. You may have to apply online or whatever. The pitch is set up. You deliver it. There's maybe follow-up questions. If they do make you an offer to invest or, authorise a grant to you or authorise a loan or whatever, then they might do some what's called due diligence. So that's basically just checking out your business, because obviously what they've heard so far is just from you. So they might want to check out your accounts, your tax affairs, make sure there's no skeletons in the closet. There are legal matters, there's no pending legal cases on you, and they might want to see some of your bigger contracts, just to kind of make sure that they're in place with people. So that's just basically kicking the tires on a business and making sure that it's everything's above board, everything's as it says it is, and there's no underlying issues before they put the money in. And in completion is just when they actually give you the money, deliver it, sign off the grant agreement, sign off the loan agreement, whatever, and you get your money. So I guess just on the pitch itself, I guess, yeah, a lot of it's about the value you will deliver. So a kind of more distilled version of the business plan, I guess, in terms of what you're going to do, what you're going to create here, what return are you going to create for you and the investor, and by when, effectively come back to that timeline if you can predict it as best as possible. Again, coming to the product, what savings or enhancements are there from your product, and is it an upgrade on what they currently buy or see in the market? If it's a service, can you compare your service levels to other supplier levels? About, I don't know, in terms of conversions, it might be in terms of successful inquiries or results you've got for your customers. If there's any statistics on that, yeah, good time to bring them out. Is there any endorsements from current customers that you can bring, which would be very useful? And how can you, I guess, show that your business can be recurring? How can you retain customers? How can you potentially upsell to existing customers if you had the investment? We're trying to sell a business right now, for example, where we're making a big play in the fact that it's a family business, and if they sell it to a bigger firm, then they could put a lot more behind it in terms of marketing, in terms of renewable products, in terms of other products, which might actually really put the business on to the next level. So these are things to think about. How you can, what's the potential for you if you had the money and the time and the resource? As I said earlier, think like a buyer, put yourself in the buyer's shoes. What are they going to? Why should they invest? Why is it different? And how you get customers coming back for more? And are you aware of the any risks involved in this? A risk. The almost obvious risk is cash flow, and you're trying to address that by showing this is what we're going to spend, this is what we need to make it all work, and here's our headroom as well. So that's obviously a key thing you're going to try and get across with your projections. But it's other risks at all that you can mitigate if certain things happen. But it might be if there's problem with suppliers, you're going to keep certain amounts of stock. If there's competition and people open up nearby, how do you relocate? How do you pivot your offering and what you do to make it better? The actual pitch deck itself, and again, we'll look at the example, and it can be just 10 slides or whatever. It's whatever you think is appropriate. But as I say, you might only get 10 minutes to pitch. But again, a bit like the business plan, it should be straightforward, easy to read, no jargon, and even more so, no long sentences or big chunks of narrative, because they're really just going to see it. Might be like this, you just see it on a screen. They may have the slides printed off in front of them, so you need to kind of just be quick and to the point, and think about who the audience is. Are they educated in that sector or not? Do you need to adapt it in any way to make it a bit more understandable for them? So yeah, what doesn't work? Yeah, if it's huge, if it's big blocks of text, too much content, long complicated words, if there's any spelling or grammatical errors, big no. And when you're going through the Q&A with your the potential investor or lender or whatever, if they challenge you, they ask you questions, if you do disagree with them, just make sure you've got a credible argument to say. And if you don't, then you can always say, oh, we'll look into it and come back to them. Just got to be sure you're aground, that's all. And just watch in terms of the format that they want, because you could turn up with your pitch deck or your presentation that you do, but if they want a certain style, they want a certain time frame or whatever, you just need to think about that and get it right, because you'd certainly want to adhere to what they say in terms of that. And some lenders and some investors want things to see things in a very similar format from all different opportunities they have. So you just need to be conscious of that and make sure you comply.
You think of the likes of Dragon's Den in television, you know, they're pitching, okay, they're not doing a pitching document as such, but they are pitching to the dragons. And one of the key things that always comes up is the financials, and a lot of them seem to fall down on the financials because they don't know the numbers. So, you know, as Mark will go into planning, etc., it's key that you take ownership and you understand the numbers and you understand what's in the pitch deck, and you're able to kind of defend it almost if it's attacked.
Yeah, so it's really some tips, really, I suppose, about planning your pitch, is use the strength of your team and others around you to brainstorm and see what ideas and what key things you want to say. Be clear in how you'll differentiate yourself from other opportunities. What do the funders expect in terms of style and content, etc. What examples will you use in terms of good things with good customers or endorsements or testimonials? Start any kind of stats you want to show in terms of market research and how you've been successful so far, or what the opportunity is. Gather them so you can present them. And sometimes you can present them in a nice colourful graph or whatever, so you can again get your accountant or someone to help you construct a document, just like they've helped you construct a business plan. Quite often that's what we're doing, where we're kind of starting off with the client with the projections, then we populate the business plan, and then we go into the pitch deck and then help them go out there to the market and try and get the money from various sources. So you can get help from that kind of thing, and Business Gateway as well. Allocate responsibilities for writing sections. So if you may have a team that's doing it, so you just need to make sure that everyone knows what they're doing, and it's all going to be done in time, and various sort of regular meetings throughout the process. Quite often when we're doing this kind of process with clients, we quite often have a weekly meeting, maybe even twice a week, just to kind of touch base, make sure we're all on the same page, who's doing what questions are there, etc. So it's important to kind of project manage the process. Content's more important than style at the outset, so just get something down. Just get something down to start with. Some of the narratives, some of the words that you can use. You can always cut it later, and we can always make it look nice, and with graphics and colour later as well. So it's just getting some key things down, some key bullet points, whatever that you want to have in your pitch deck. You can always remove them later. Number point 8: use a critical friend, someone who's hopefully independent to kind of read it and give feedback, and make sure you kind of finish on an exec summary and what the key messages are, what you want to leave them with on the last slide before you get to the Q&A session. Okay, so just practical points really to help. If you are in a more formal situation, like you're pitching to a panel, again, think about the format. How are you going to do it? Are you going to even simple things like stand up, sit down? Are you going to have a PowerPoint? It's going to be hard copy slides out in front of people. Will you have other handouts?
What's the layout of the room?
Yeah, what's the layout of the room? It's going to be a table sort of environment. It's going to be theatre style with rows of chairs. Is it a formal or a more informal discussion? And will you rehearse? Yes, you should rehearse it. And do we invite someone to kind of critique it if possible? It would be a good idea to give you that honest feedback. And then try and predict the questions and answers that you'll give to key things. Never be completely sure, but what would someone see this for the first time ask, and just try and you might have hit a head on in your presentation, but if there are other questions, just try your best to kind of construct pre-prepared answers if you can. So here's looking at an example of a pitch deck. So it's here. So again, I've had to, I'll try and put this bigger.
You go into slide. So,
see that there. See if I just get rid of that. It's that one, isn't it?
Yeah. That one down bottom.
There we go. Can you guys see that okay? Can you guys see that okay?
No.
Can't. Zoe, is that you?
Yeah, that's me.
Can't see that. You can't see that on the screen.
Let me just try changing my view. That's it now. Yeah.
Oh, you can see it, right? And
yeah.
John, you okay seeing it?
Yeah, sorry, I didn't know you couldn't see me. Yeah, I can see it all right.
Cool, excellent. So this is a pitch deck we worked on a while ago, and it was for a client who had a new app for a phone, and it was really based around a very, very safe place to put photographs that was basically unhackable and could be shared online. It sounds a bit like Facebook, but it was sort of directed at the sort of Muslim community, and they spent quite a lot of money developing this, and then they eventually sold it to someone who could further develop the technology. So and again, I've anonymised it, so it doesn't look quite as good as it could, because I've had to replace it all with the one's logo, but it's just to give you an idea of what a pitch deck might look like. So you can see here just some nice graphics and things, disclaimer just about this shouldn't be, information should be used for other sort of things. So and if you invest, there's some typical words usually in these sort of pitch decks about if you are investing, then you should be a high net worth, sophisticated investor. That's kind of regulatory stuff, so I won't go into that. So this you can see here is, but sort of again just looks quite different from a business plan, because it's very much, you know, bullets, small kind of bite-sized statements. And obviously you'll be talking to it, so it's more about what you say and what's on the document, but this can be good prompts. So you're trying to just show some of the key quality things about this particular opportunity, some nice graphics about the product or what it will show, and key highlights so far in terms of what they've done, what they've raised. Obviously emphasising really positive stuff about revenue generation, future plans, what that's going to mean in terms of users and like year 3, year 5, etc. So business to business, business to customer, sort of split. So key highlights, easy to digest, very clear to see stuff, not any real chunks of narrative as such. Here's the kind of opportunity. There's to talk about basically security over online stuff and being hacked.
And that's quite an important thing, is to sort of address the problem you're solving in this situation. So outline what the problem is and then how your technology or your product is going to solve that.
Yeah. And again, just kind of bullets about just to get the messages across that this is a really good product and this is what it's going to do for you. Comparison with other products. So quite often you see a table like this in the business plan or pitch deck where you've talked about compare yourself to competition, so you can show other products or other competitors in your field and all the kind of things that they should do. And obviously you're trying to tick all the boxes, and the competitors don't tick all the boxes, so you're clearly showing that your product is better if you can. So we see that quite a lot in these kind of things. Any statistics about the market and the size of the market, and obviously trying to show how big it is for you and what the opportunity is. Again, more market information about and hopefully showing it leads sort of links quite nicely to your product and why it's so good and what the opportunity is. what's happened so far. Again, some good wins. Effectively, I suppose that's like not quite testimonials, but good evidence of what you've done with customers. Pipeline, some case studies as well about customers. I guess really good things to say that you've done if you can. I guess in your case, so you might be sort of showing to people what results you've had mortgage-wise, who your kind of key suppliers are, and what successes you've had over time. And the team have anonymised this, so obviously you can't see the photographs and the CVs, but you might have a little colourful summary of the team, and there's a short mention of their experience. And who else you're working with, because that can obviously give a bit of credibility in terms of if you're working with some of these bankers, advisors, lawyers, etc. Then all these things can be good in terms of building up the credibility of your business, and show you're dealing with recognised names already. We mentioned timeline a little bit earlier, so you might want to show right from now over the next few years key milestones. You're opening up this, you're doing this, you're doing a marketing campaign here, you're developing this, etc. You might expand to another location by this point, so you can show a clear plan in your head. Revenue, so yeah, some of the financials and the projections, revenue from different sources, maybe nice graphs. Again, you can see just nice colour, nice and clear, and again, it's a even more summarised version of the projections that you've already completed. More stuff here about the EBITDA we mentioned earlier on, the revenue, showing how the cash balance changes in a graph, and how the revenue changes, the EBITDA changes in the graph over. So straight from the projections, quite easy to convert with software these days, a sort of Excel set of projections into a nice graph, and we can put it in here. Makes it look very professional, very good. And then some key highlights in terms of the investment, and what you're actually looking for and what you'll spend the money on. So there you go. Any questions on the pitch deck? Okay.
Nope. Quite straightforward.
Okay. Here we go. Yeah. So I guess just moving on to, I suppose, beyond that, then just going further down the timeline, we want to talk about some of the things, and we'll talk a bit more about these at workshop too as well, because I guess once you've got someone interested to invest, to lend, for example, then I guess what might come up is, well, how much do you value your business at? Because particularly if you're wanting to get someone to buy shares in your business, equity investment, then how much, if you want, say, 250 grand, how much equity do you want to give away to someone for that? And they may have a very different idea of what that is than you. So you might want to have a good idea of the value of your business if you can. We'll talk about that. Also about the terms and conditions that might come with an offer of investment or a lend or a grant being given. The due diligence, we mentioned that earlier, what they might do to check out your business and eventually completion and actually getting the money. So the valuation, if you're thinking about a valuation of a listed PLC, it's quite easy because those shares are listed every day at a certain price and times that by number of shares, and that's your valuation of that PLC business. For a limited company or a sole trader or a partnership, it's very subjective about how you value that business, and you can bet that your idea of the value of it compared to an investor will be quite different. I guess if you're looking to value a small business, then I guess the kind of theoretical, technical way you should do it is discounted cash flow, because if you're holding a share of a business or a stake in a business, then it's all to do with what you're going to get from that stake in the future. So if you're going to get income from it by way of dividends or whatever, you eventually sell those shares as well, or that stake, if it's a partnership or a sole trader you're talking about. So that's the income you're going to get from that, your investment. So technically, the way to value that holding, if you like, is you can, if you can, predict the income you're going to get from it in the future, dividends, income, selling it, and then discount it back for, you know, risk factors, inflation, etc., to present day. And that's a kind of technical, mathematical way of valuing something. In practical terms, that's really, you can't really use that, because that's all based on projections, which are completely subjective. And while you might be very confident in them, someone else will probably not be so confident. So it's a really difficult one to justify that in an early stage business in particular. If you've got an established business which is trading pretty consistently, revenue and profits year in, year out, you can make the assumption, well, that's going to continue. So let's take that and discount it through some kind of mathematical model, and that gives you a value. But a lot of the things that we deal with aren't like that. A typical way of valuing a business is to take what you see as their sustainable profits times an industry multiple. So first of all, you're saying, right, this is what we think we're going to make in terms of profit in our every year going forward, or our best approximation of what it could be. So quite often you're looking at the last few years or the last year to say, right, here's the profits we've made, will it continue like that? And you adjust it for things like one-offs, and even things like the director's remuneration, because quite often the director might be taking out a small salary, and really you're valuing a business on an arm's length basis. So it's kind of like as if you put an employee in that place. So you put in a normal salary for that person, for example. So you make adjustments to get to what you think is a sustainable profit for that business, and then you times it by an industry multiple. So really that's what we mean by that, is businesses that are selling in the market, what multiple on profit are they selling for? So if a business is sold for £1 million, but it's making £250,000 profit every year, and it's sold for a multiple of 4 on that profit, okay? And typically a kind of 4 or 5 multiple in a traditional industry is kind of common these days. So which kind of makes sense, because if you think about it, if you're buying a business for £1 million, say, then you're probably going to want to be paid back in about 4 years for that investment. So multiples of 4, 5, 6 are quite common these days. In some very technical areas like software development, you can get multiples of 10, 11, 15, but they're very, very kind of outliers. In a normal business, you're talking about 4 to 6 on sort of profit levels. So that's a kind of typical way that businesses are valued at. It can be difficult if you don't have any revenue yet. If you're pre-revenue, how do you value a business then? Because all you've got is your projections. So quite often, when we're trying to fundraise for a pre-revenue business, it's very much the owner will probably have a very high valuation of the business, because they very much believe in the product, believe in the opportunity, and they all come in as quite high valuations. But then the investor will say, well, no, you haven't done anything yet, and there's huge risk about this, so I'm only willing to pay you a fraction of that. So ultimately, it is what someone's willing to pay. It's just really a negotiation exercise after that. Once they've seen the business plan, heard the pitch, it's up to them to make an offer. And usually, like you see in Dragon's Den, they usually come in a lot lower than what's asked for, and it's a case of just negotiating that to try and reach an agreement. So if you have actually, you've settled that, you've got the price, the investment, and the number of shares or whatever they're going to get for that investment. But even if it's a lender, they'll want to maybe do some due diligence on your company.
Same with grant bodies as well. They'll do a degree of diligence in the application.
Yeah. So as I said earlier, look at the financial, any legal skeletons in the closet. Look at your contracts potentially, look at the historic trends and what your projections show. Robustness of the balance sheet. So looking at the balance sheet in terms of how much cash you have, what your current assets are. For example, if you've got huge creditors and you haven't paid them, why? And how liquid really your business is. It might all be tied up in fixed assets and equipment, for example. So they want to check that out. They want to make sure that you have included all your liabilities. So if you've got any additional monies due to someone or a tax man or whatever, to make sure that's all captured. There isn't any skeletons in the closet in terms of tax, and they're all up to date. And if there's any payment plans in place, like looking at them. Intellectual property, it might be that you've developed something that's not on the balance sheet because you haven't bought anything, but it's something you've developed in house that actually is now worth something, and you might want that valued. There's specialist valuers that value intellectual property, like Metis Partners, for example, in Glasgow, who we've used sometimes. So that's quite often, obviously, in the sort of more technology field. If someone's developed a new kind of widget or a screw thing or new type of concrete we came across one time, and they went and got it valued with Metis to get because obviously they're saying, well, this intellectual property developed is worth 5 million, 50 million, Metis say, and obviously they can use that as a hook to get investment. If there's any contingent liabilities, what I mean by that is sometimes if something happens, then you might have a liability appearing. So, for example, dilapidations on a rented premises, for example, that might mean in your lease you might have to pay them. So that might be contingent on something on you moving out that premises. Leases and service contracts, what you've got in place in terms of leases for cars, equipment, etc., what you're committed to, that's all part of the business assessment as well. And ultimately, they might use this as a bit of a negotiating tool. So sometimes you see that due diligence is done, and then people come back and say, investors come back and say, well, actually, we spotted this, we spotted that. So either we want to reduce our offer a little bit because there's a bit more risk there than we thought, or they might say, might put warranties or indemnities in place. So they might get their lawyers to write up that, for example, if anything does happen, anything that comes out of the closet for tax or legal affairs, for example, from the past, if that raises its head again after they've invested, you'll be hit for the whole thing, and they won't have to actually pay anything at all. So warranties and indemnities are quite often a part of a kind of share purchase agreement or investor agreement, just to kind of clarify those things. It's quite often what a lot of time spent on, isn't it, when that completion process about warranties and
investors
indemnities.
will want the management to warrant that things are true, basically. So that'll be part of the investment agreement.
Yeah.
And I've actually been the odd occasion where years and years ago, we had a funder who did some diligence on a proposition, and they came back and concluded that the business actually needed more funding than we were asking for, and they were willing to provide it. And that's a very rare occasion, but it did happen.
So once you got through that, then eventually completion in terms of, it depends what kind of funding you're going for, because it might be an investment agreement if it's equity, might be a bank facility letter if it's a loan. And you've got to think about the securities that are attached to these things. So we mentioned about personal guarantees before, can be common, and you might find that unpalatable, or they might take a security over, say, a property you own or equipment you own, so that if there's loan defaults, they can basically seize that and sell it to pay back themselves. So you've got to think about the securities that come with any kind of offer. And grants as well, they quite often come with conditions about how you can spend the money, and how you quite often have quarterly reporting or annual reporting, which says you've got to provide them information about what you've done and what it's been spent on. Sometimes you have to get a reporting accountant to actually sign off on that, and that's we do some of that sometimes, and to get the next tranche of a grant if it's paid out over a few years. Some of these investments come with conditions, so it might dictate, for example, that directors can't take dividends for the first few years. They just take a salary capped at X. So there can be some conditions around that for the owner, and also look at post-completion obligations. So some investors or lenders want to see regular management accounts every month, every quarter. They might even want to attend meetings with you every month or quarter or whatever, depending on how active they are. But they probably want to see something, just to see how their investment's doing as time goes along. So you just need to assess that and make sure you're happy with it. So I guess a recap of key points, I guess, that we've talked about today is making your proposition and unique selling point clear of your offering. Think about your growth strategy in terms of practicalities. When and where is it going to happen? How much is needed, etc. The right management team, having the right management team in place to actually do this and deliver, the right team of advisors around to actually help you raise the funds, be very clear about how much funding you want and what's it going to be spent on, and that comes from your projections, and looking at that comes from your cash flow deficit and your projections, and therefore what funding is needed. Consider the obligations and conditions, as I just said, of any kind of offer you've got. Make sure you have your key documents, your business plan, including the financial forecast, projections, and the pitch deck as well. And as I said right at the start, you kind of need all these things, no matter how formal it is that you're going out there for money. Because even if someone doesn't want to see a formal business plan and pitch deck, they're going to want to know the same kind of things that are in it anyway.
And don't underestimate, as I said at the beginning, the time it takes to get funding in place. It's not a quick process, and 9 times out of 10, your business plan will be one of 10, 20, 30 business plans that a funder's looking at any time. So you're not their immediate priority. So allow time, have a bit of visibility in how your business is going to roll out, when you're expecting funding is going to be needed, and make sure you sort of start the process early enough that you allow yourself the right amount of time.
Yeah. Just going back to this summary, because obviously, as I said at the start, this is workshop 1, becoming investor ready, and workshop 2, more detail on the sources and types of funding, is on the 13th of March in person in Bathgate, and the online version on the 20th of March. So please, if you want to sign up for the second one, then go online and do so. Okay, so I know I've had some questions along the way, but if you've got anything else you want to ask, please do so. And obviously, you've got our details. We'll send these slides out anyway to you, so you've got our details there. But anything else that you want to ask now, please do so, or approach us later. We're happy to always chat about anything that's on your mind. Anything else at the moment?
No, it was great session, learned loads. So even with the business plan, I thought I was all up to date with that, but I got a few points from that. So thank you so much. It was great.
No problem, no worries. And Zoe, if you get any queries or whatever after, just give us a shout if that helps.
Yeah, lots of food for thought. I think it's probably something I'm not ready for yet, but definitely gives me a good idea of what direction and what I need to do in the future.
Yeah. Cool. Great.
Okay. Good stuff.
Nice to meet you both.
Yes, very
Lovely
much
to
so.
meet you too.
We'll
Thank you so much.
Through the framework, So.
But please let us know anytime you get anything in your mind, okay?
That's great. Thank you very much.
Thank you. Take care.
Bye.
Bye.